Hello everyone, we are Team Chester and today we will be presenting the business strategy and performance of our company throughout the Capsum business simulation. In this presentation, we'll walk through the strategic decisions that guided our approach, the outcomes we achieved, and the key lessons we learned along the way. We'll also highlight the collaborative efforts across our departments that were essential to our success in a dynamic, competitive environment. To keep our strategic decisions aligned and focused, each team member took on a leadership role in a core area of our business. I oversaw research and development, Sarah directed marketing, Samantha led production, Arev handled human resources and total quality management, and Silas was responsible for finance. This clear role distribution helped us collaborate to make well-informed, timely decisions and ensured smooth coordination across all departments in the simulation. For our business strategy, our team decided on the niche differentiator with a high-tech focus. This meant that we focused on high-value segments, high-end performance and size, while reducing investment in price-sensitive areas like traditional and low-end segments. We positioned ourselves as a technological leader, prioritizing high R&D investments to maintain cutting-edge product positioning and low product age. Lastly, we adopted a customer-centric approach, meeting the customer buying criteria, keeping products at pace with the market, increasing accessibility and awareness for customers, and making sure that we were pricing above average to reflect our premium quality. Under our niche differentiator strategy, each department had a clear focus. R&D invested heavily in innovation to stay ahead of customer expectations. Marketing focused on high promotion and sales budgets to drive product visibility and accessibility. Production expanded capacity carefully to meet demand without relying on overtime. Finance prioritized a strong cash position to avoid loans and used retained earnings to self-finance investments. Human resources and total quality management worked on a developed, skill-efficient workforce while improving product quality and reducing costs. Our research and development strategic plan was to differentiate through product positioning and superior products. We aim to stay on pace with the high-tech market through continuous innovation and launching new high-tech products at ideal positioning on the perceptual map. This would ensure that we were meeting the customer buying criteria and allow us to gain a competitive advantage. Here's a breakdown of our product portfolio. SID and Cozy. SID was our original high-end product and Cozy entered R&D in year 1. Both products were in ideal positioning for performance, size, and age for a year 2 product launch. Coat and Cat are in the performance segment, with Cat entering R&D in year 2. We set MTBF and positioning for ideal expectations for a launch in year 3. Cure and Camp are our size segment products. Camp entered R&D in year 3, with timing and positioning calibrated for a strong year 4 debut. And lastly, Cedar and Cake were our traditional and low-end products. We made minimal changes to these in order to sell off inventory and retire them by year 3. Wrapping up research and development, here are some of the key lessons our team learned. First, product positioning is key. With a high-tech niche strategy, nailing product positioning and consistently meeting customer expectations is essential to staying competitive. We also learned that timing is everything in R&D. Starting projects that can't be completed within the year can set you back, so it's better to break up major innovations across multiple years. Another key insight was the importance of collaboration between departments, especially between R&D and marketing. You want to be able to boost awareness, accessibility, and overall customer satisfaction of your products. Another takeaway was product differentiation. Launching more than one product in the same segment, it's going to be crucial to differentiate them clearly, both in terms of pricing and positioning. That way you can avoid cannibalization of sales and any internal competition. And lastly, trust the process. Competing with a niche differentiator strategy, especially with a high-tech focus, is going to require significant upfront investment in R&D. The returns may not be immediate, but staying committed to your strategy and maintaining alignment across departments is key. With patience and consistency, the profits will follow.
As part of our niche differentiator high-tech strategy, we deliberately positioned our products at a premium price point within each customer segment, consistently setting prices above the industry average. This pricing strategy was designed to reinforce the perceived value of our technologically advanced offerings and align with our brand image as an innovator in the high-tech space. When launching new products within each segment, we implemented a strategic pricing adjustment by lowering the price of the existing, now older product line by 50 cents. This price reduction served several purposes. It created a clear differentiation between the newer and older models, highlighted the added value and enhanced features of the new product, reflecting the higher costs associated with research and development, and ensured that customers recognize the technological progress embedded in our product lifecycle. We utilized the December customer survey score method as our primary forecasting model. This approach aligned well with our overarching high-tech strategy, which emphasizes customer satisfaction and innovation. By focusing on the customer satisfaction scores captured in December, an indicator closely tied to segment demand, we were able to generate more precise sales forecasts. This method provided valuable insights into consumer preferences and buying behavior, allowing us to more accurately estimate unit sales and make informed production and marketing decisions across each segment. Our sales budget strategy focused on front-loading investments in the early rounds to quickly achieve 100% accessibility across all segments. We began with a substantial initial investment of $3,000, which allowed us to build a strong foundation. Once full accessibility was reached, we strategically scaled back our spending to $1,300 per segment, maintaining 100% accessibility consistently over the final 4 years. This approach enabled us to maximize long-term reach while optimizing budget efficiency. Our promotional budget strategy closely mirrored our sales budget approach. We invested heavily in the initial rounds, allocating $3,000 per product to rapidly achieve 100% brand awareness. Once that target was met, we transitioned to a more sustainable model by adjusting each product's promotional budget based on its share, aiming for an optimal long-term investment level of $1,400. However, in year 6, an attempt to reduce costs led to a uniform decrease in promotional spending across all products to $1,300. This misstep caused our overall awareness to dip to 98%. Recognizing the impact, we promptly corrected course in the following rounds by increasing the budget back to $1,400, restoring our position and maintaining strong market visibility.
Our plan consisted of strategic capacity planning, automation control, inventory management, and alignment with R&D. For our strategic capacity planning, we focused on our investment. We targeted capacity expansions in alignment with our product launches. We were efficiency oriented. We avoided overexpansion and kept capacity tight to minimize idle resources. We were demand driven. We built capacity based on our forecast to capture the highest sales. For automation control, we had a balanced approach. We maintained moderate automation so that we could stay agile. Our goal was to be responsive to the R&D schedules. So we eliminated automation so we could have the frequent updates for our products. And our inventory management, we were forecast-led in our production schedules. We utilized our customer satisfaction survey scores to help plan in our forecasting. Additionally, we also had a buffer strategy where we increased our production schedule from 10 to 20% so that we would not meet on the demand surges and so that we would meet the demand surges and not miss out on any sale opportunities. And our alignment with R&D, we made sure to have a cross-functional collaboration and synchronization. Our production plans were tightly coordinated with the R&D schedules. We ensured launch readiness and speed to market. Of our business, included the discontinuance of product lines in the traditional and low-end segments. With those discontinuance, we had a scaffolding approach where we tapered off for the first 3 rounds, and as our products were being discontinued, we were also introducing new products that aligned with our business strategy. We also had an aggressive growth and or buffer that we included, and this was 20% above marketing with our product lines that aligned with our business strategy. Then once we made our presence in the market and established our name, we then shifted to a more conservative growth and did not have such large buffers and inventory on hand if the product didn't sell. And as we progressed, we had some financial constraints. So that led to us not being able to invest in capacity the way that we would have liked. And thus we had to use our plant and second shift to a greater level in order to meet the demand of the product.
Human resource strategy for niche differentiator, high-tech focus. To support our niche differentiator strategy, our human resources approach focused on attracting and retaining highly skilled employees who could drive innovation. We increased our investment in recruitment to bring in top-tier talent, particularly in R&D roles. By boosting training hours, we improved productivity and empowered employees to collaborate more effectively across departments. We also offered a competitive compensation to reduce turnover and keep our team engaged. These HR initiatives helped create a workforce that was aligned with our high-tech focus, ultimately enhancing our ability to bring in differentiated products to market faster and more efficiently.
Total quality management strategy supporting high-tech differentiation. Total quality management played a critical role in reinforcing our strategic goals. We implemented initiatives like benchmarking, Six Sigma training, and quality function development to ensure our processes were efficient and our products met high standards. These efforts reduced our R&D cycle time and minimized production defects, both of which are crucial when you are targeting the high-tech segment. With customer needs and feedback guiding product development, we were able to deliver high-performing solutions that stood out in the market. Our investment in TQM not only supported innovation, but also helped control cost and enhance customer satisfaction. Human resources.
When we finalized our decision on which strategy to take for managing Chester, we knew it would be very high risk. Most competitors would keep products in every segment, raking in cash, while we could potentially never gain market share if our competitors have the cash to dump in their products. As much as cash reserves and retained earnings look great to investors, it'll bump up their stock price, we knew we'd have to forego holding on to all of that in the long run in order to achieve market dominance. Whatever revenues we had went back into the business. That means more capacity, better products. It was always product first, and bond financing was the way to get there. There is a method to the madness. Successful debt management is not just racking up the debt to keep the ship afloat. Our goal is to mature in our segments, achieve market dominance. That means we keep borrowing to the absolute minimum. We borrow just enough when needed to maintain positive cash flows and continue investing in our products and production capacity. When we're in a strong cash position, we pay off the debt early. This saves on interest and opens up opportunities to borrow later if necessary. We keep equity. We hold on to equity for the long run. We take it out of the equation because there's no reason to sell off shares early when we know in the future they'll be worth more. This light touch with our leveraging is evident in our 2027 and 2028 cash flows. Because we didn't need the cash for our investments and operating activities in 2027, we opted to pay off some of our debt, reducing our interest payments for the following periods, allowing us to borrow later if necessary. The same was true in 2028. We didn't need more cash at the time, so no need to borrow. There is an opportunity cost associated with making early bond payments. While we are saving $3.78 million in interest, we're losing out on the opportunity of $4.94 million that we could be investing. Our strategy was to keep leverage as minimal as possible, so it was better that we save on the interest and forego the $4.94 we could invest, especially when we would see diminishing returns on any further product or marketing spending, and production capacity at the time was robust enough to meet demand. Taking everything in, we accomplished what we set out to do at the beginning of our tenure at Chester: achieve market dominance and deliver the best products. We're nearly 12 points ahead of the next competitor in the performance segment at 27.4% market share. We're the top company in the segment. In the size segment, we're also ahead by 4.5%. We're also the top company in this segment at 25.6%. Our revenues continue to climb and our market valuations climb to match, as shown in our stock price. Here are the percentage gains from the previous years by revenues and stock price. In each year, we saw the largest gains in the industry. Our gains in stock price the past 3 years are notable not only because of newfound investor confidence in our company, but also because our current and projected valuations in the preceding years will allow us to pursue our pivot from bond financing to equity financing. Having to pivot from bond financing to equity financing speaks to one of the weaknesses that our strategy imprinted on the business: being over-leveraged. With our financial restructuring plan for the next 3 years, that'll change. Despite our strength in the performance and size segments, we have not achieved the same success in the high-end segment, where we're third in the market at 19.1%. This is not to say we're in a precarious position, because we're only 2 points behind the top company in the segment, and we actually saw a 1.2 point increase from 2032, with the top company in the segment actually losing 1.5% in market share, meaning we're on the way to the top. Considering how long we've hammered away at this segment, we should be further along at this point. This will play into our decision-making with where we want to focus our investment in the next 3 years. 2034 is the pivoting point for Chester, bringing our company to maturity. Financial restructuring is a major part of our strategy for the next 3 years, reducing our reliance on bond financing and moving towards equity financing and revenues to fund our continued investments in the company. In order to pursue that, we'll focus on maintaining profitability. Our dominance in the segments and prior year sales growth will take care of that for us. Customer first is still our motto, and we need to have the bleeding edge products they want. With that, we want to shift our investment to our high-end products in proportion to our other segments. We also want to grow our production capacity because in recent years, we haven't been able to meet the demand that we want to with what we have. For 2036, we aim to bring our stock price to $120 and above, grow revenues to $300 million and higher, and have profits of at least $30 million. This stock price valuation is very much tied to our profitability. As we saw when we began to turn a profit, our stock price shot through the roof. Based on our projections, these metrics are really realistic for us to hit. As far as our products, we want to become the top company in the high-end segment. We are seeing some growth in our market share, but with more of our investment going towards our products in this segment, this is achievable. Taking into consideration that the first and second top companies are only a couple points ahead of us and losing ground in the segment. Of course, we still want to maintain our strong positions at the top of the size and performance segments. Getting into our pro forma income statements for 2034 through 2036, these projections vary from metric to metric. For metrics labeled as calculated with rate, we looked at the rates of increase from 2030 to 2033 and took the average. Reason being, the rates of increase were close together enough each year for them to be accurate. For metrics labeled as calculated nominally, these were metrics that were too variable each year to use the rates of increase, so we took the average of the values. These metrics weren't very far from previous years and they weren't very impactful. R&D, promotions, and sales are set expenses each year as we saw diminishing returns in previous years when increasing any further. With our net profit in 2036, we believe that our stock price goals are doable. With stock price, our recent data was too variable to use rates of increase directly, especially because of the market's dramatic response to our profitability. Instead, we opted to use a weighted average of industry rates of increase from 2031, 2032, and 2033, with companies that were underperforming or saw no growth having a lower weight. That value was then weighted against our rate of increase with a weight of 0.7 and our rate of increase having a weight of 0.3 to accommodate our company's maturity in the market and our segment dominance. Our revenue gains have been very consistent since 2030, so we stand behind the integrity of these revenue projections. The next 3 years will be Chester's best years yet. We look forward to seeing the company flourish. We thank you for your trust in us to continue steering the ship, and thank you for your time. Take care.